Alex is standing on the front step of a house he has paid into for years, holding one folded document. Behind that door are the floors he repaired, the water heater he replaced, the walls he painted the weekend. The place finally felt like his. He made every monthly payment. He treated the house like it was his, because he believed it soon would be. But the paper in his hand says, the seller wants the property back. And something cold settles in, because his name was never on the deed, not once. This is how a rent-to-own home can take years of your money and still leave you with nothing to own. How does a person end up here? It does not start with a mistake. It starts with a door being closed. The notice in Alex's hand is not a bill. It is a warning. Depending on his agreement and his state, it might be called a notice of default, a forfeiture, a cancellation, or a demand for possession. The words differ, but the message is the same. The seller is saying the deal is over, and the house is theirs to take back. And Alex is standing there doing the math. He has paid for this home longer than some people keep a car. He fixed what broke. He never skipped a month. So how can someone pay for a house for years and still be told to leave it? That question is the whole story, and the answer surprises almost everyone. To understand the notice, you have to go back to the day a bank told Alex no. He did the responsible thing first. He sat across a desk from a lender and applied for a normal mortgage, the ordinary path millions of people take. But his credit had some rough years in it, his savings were thin, and his income was steady yet hard to document the way lenders like. The officer was polite. The answer was still no. If you have ever been turned down for something you needed, you know it is not only a financial event. It is a quiet embarrassment. Alex was tired of asking permission to paint a wall, tired of wondering whether the rent would jump next year or the lease would not be renewed. He wanted a place that stayed his. And the bank had just told him that place was out of reach. That is the exact moment the next offer found him, as a sign. The kind you see on a corner or scrolling past on your phone. Rent to own. No bank needed. Bad credit okay. For a man who had just been rejected, those words did not read like an advertisement. They read like a door reopening. He was calm and reassuring this seller. Move in right away, he said. Part of every payment would count toward owning the home. The upfront money would lock in the purchase price so it could not climb out of reach, and Alex would have time to fix his credit and buy the place properly down the road. Nothing about it sounded like a trap. It sounded like a plan. The monthly payment was higher than plain rent, but Alex did not see that as a cost. He saw it as an investment in a future he could finally picture, so he signed. Here's where we have to be precise, because rent to own is not one thing. It is a label stuck on several very different agreements, and the differences decide everything. With a lease option, the tenant generally has the right, but not the obligation, to buy. If the purchase does not happen, the option fee and any purchase credits may be lost, depending on the agreement. A lease purchase is stronger. There you may be contractually committed to buy at the end, not merely allowed to. A contract for deed, also called a land contract, is different again. You pay the seller directly over time, you live in the home and take on the duties of an owner, but the seller generally keeps legal title until you complete everything the contract requires. Only then does the deed come to you. A traditional mortgage works almost the opposite way. With a traditional mortgage purchase, the buyer generally receives the deed at closing, while the lender takes a lien or another security interest in the property. The exact title mechanics vary by state, but the buyer usually does not wait until the final payment to receive the deed. Alex's agreement was a contract for deed dressed in rent-to-own language. That single fact shaped his entire risk, and he did not grasp it when he signed. Think about what that means. From the first day, Alex carried the weight of an owner while holding much thinner rights. The seller still held the deed. The agreement used the vocabulary of ownership everywhere, but the money did not, by itself, make him the owner. Only completing the contract on the seller's terms would have done that. Now, the upfront money, because a lot of hope gets buried here. In a contract for deed, there's usually a chunk of money at the start, an upfront down payment to the seller. On top of that, Alex's monthly contract payment was higher than the cost of renting a comparable home, and part of that extra amount was supposed to be credited toward the contract balance under the agreement. But whether that money ever turns into ownership depends entirely on the contract and on state law. Amounts credited toward the balance are not guaranteed to become equity. They are a promise on paper, and the paper usually says they only count if you complete the purchase on time, exactly as required. The deal borrows the language of ownership, but the money paid does not transfer the deed on its own. While the contract sat in a drawer, Alex did what any proud homeowner does. The roof leaked one autumn, and he paid to fix it. The old water heater died, and he replaced it. He tore out the damaged flooring in the back room and put down new. He painted rooms in colors he chose. He planted something in the yard, the kind of thing you only plant when you expect to watch it grow. Every one of those repairs did two things. It made the house better, and it made Alex less able to walk away. He was not only spending money on the property, he was putting evidence of a future into every room. Mail arrived there in his name. His kids learned the sounds the house made at night. It felt like his. So who actually owned the property this whole time? Legally, the seller. The deed carried the seller's name, recorded in the county records. Was the seller's ownership even clean? A seller can hold title and still have an unpaid mortgage, back property taxes, liens, judgments, or an old ownership dispute nobody mentioned. A title search exists to surface these things, and checking the deed in the public records is how a careful buyer confirms the person selling actually has the clear right to sell. Whether and how these agreements get recorded also varies by state, and recording can matter a great deal. This leads to a problem that catches people off guard. It said there can be two sets of bills running at once. Alex was paying his monthly amount and his repairs, and depending on his agreement, possibly insurance and property taxes too. Meanwhile, the seller may still have owed an underlying mortgage, taxes, whatever liens existed. And Alex paying faithfully did not guarantee the seller was paying too. If a seller in this arrangement stops paying the mortgage underneath or lets the taxes go unpaid, the home can be pulled toward foreclosure or a tax sale by forces the buyer cannot see and did not cause. Then the deadline arrived, and everything came due at once. The contract required him to finish the purchase by a certain date. To do that, he needed real financing, a mortgage or a refinance, or in some versions, a single large payment at the end called a balloon payment, a big lump sum due all at once because the smaller monthly payments were never designed to pay the whole thing off. And this is the twist that surprises people. You can afford the monthly payment for years and still fail at the final stage, because qualifying for a mortgage is a completely different test than making one. So Alex went back to a lender. They checked his credit and income, ordered an appraisal, and looked at the property's condition and title. The appraisal came back below the contract price. The home was not worth, on paper, what Alex had agreed to pay. The loan would not cover the gap, and he did not have the cash to make up the difference. His credit had improved, but not enough. The financing was denied. The contract did not require the seller to extend the deadline, and whether Alex had any additional rights depended on the agreement and state law. Let me put the money in front of you plainly. I want to be careful because these numbers are a hypothetical example, not a claim about every deal. Say, Alex paid an upfront down payment of $8,000. His monthly contract payment was $400 higher than the cost of renting a comparable home. Over 36 months, that difference totaled $14,400. Add $12,000 in repairs, and Alex had put $34,400 beyond comparable rent into a property whose deed still had not transferred to him. That is money placed at risk beyond comparable rent. Some cautions. This is a hypothetical example, and not every agreement works this way. Ordinary housing costs are not automatically lost money, and how much is actually recoverable or lost depends on the agreement and state law. Alex did not pay anything close to the full purchase price. and repairs do not automatically create ownership. But the down payment, the extra amount, and the repairs are the pieces most at risk, and $34,400 is a devastating amount to watch slip away. Now the notice becomes real, and this is the part that hollows a person out. Alex is told the deadline expired, the financing condition was not met, and the agreement may be canceled. The seller wants possession. He had a key to the front door. The seller had the document that mattered more, but here I have to be honest rather than dramatic. What happens next is more complicated than a simple eviction, and it depends heavily on the contract, and even more on the state Alex lives in. The words matter here because they are not the same thing. Default just means a term of the contract was not completed. Forfeiture, cancellation, eviction, and foreclosure are different processes with different protections, and states treat contracts for deed very differently. In some states, a buyer who has paid only a little can be removed fairly quickly. In others, once a buyer has paid a meaningful share, the law requires a slower process, closer to a mortgage foreclosure, and some states give the buyer a period to catch up on what is owed. The point is not the label. The point is that the notice and its deadlines have to be taken seriously, and this is a moment for qualified local legal help. That is what Alex did. He took the agreement to someone qualified in his area and went through the required local process. And in the end, the answer did not change. He could not complete the financing, and he could not keep the contract alive. After the process ran its course, he had to leave. The deed never transferred to him. That was Alex's outcome in Alex's situation. It is not a universal rule, and another buyer with a different contract in a different state might have had different rights, a different process, or a different result. What stayed true for Alex was the hardest part to accept. The seller did not simply remove him overnight, but the paperwork, in the end, decided who kept the house. Before we get to what Alex could have done differently, here are the warning signs because most were visible from the start if you know what to look for. Be cautious when a seller refuses to show clear proof of ownership, discourages a title search, or resists an independent inspection. Watch for promises made out loud that never make it into the written contract, an unclear purchase deadline or final payment, or vague language about who pays for repairs, taxes, and insurance. Be alarmed if the purchase price sits far above what the home would appraise for, if the seller still owes a mortgage or taxes on the home, or if there is pressure to sign right now with no time for your own attorney to read it. No single one of these proves fraud. But the more you see stacked together, the louder the alarm should ring. So what should Alex have checked before he ever signed? Identify the exact contract type, by name, confirm who legally owns the property, and review the deed and public records. Get a title search, and check for mortgages, liens, unpaid taxes, and ownership disputes. Get an independent inspection and an independent appraisal so you know what the home is really worth. Understand the purchase price, the down payment, and exactly how payment credits work under the agreement. Understand who pays for repairs, taxes, insurance, and maintenance. Confirm the financing deadline and whether a balloon payment is waiting at the end. Have your own local attorney review the agreement, not the seller's. And before signing, talk to a lender and a housing counselor who participates in the program run by the Department of Housing and Urban Development. Keep copies of every payment and repair receipt too. None of this guarantees a perfect outcome, but it turns a blind leap into an informed decision. And if a bank has told you no, rent to own is not your only path. You can keep renting on purpose while you rebuild your credit and pay down debt to improve your debt-to-income ratio. You can save toward a down payment. You can look into first-time homebuyer programs and loan options through the Federal Housing Administration, the Department of Veterans Affairs if you served, or the Department of Agriculture's rural programs. When you genuinely qualify, you can sit with a nonprofit housing counselor and build a real plan. A housing counselor who participates in the program run by the Department of Housing and Urban Development may provide free counseling or charge a reasonable fee, depending on the service. Not everyone qualifies for every program, and none of it is instant. But waiting a year to buy a home the ordinary way can beat spending 3 years buying one on terms you never understood. Come back to Alex on that front step. He thought every payment was buying a piece of the house. What each one actually bought depended on the contract, and the contract asked for one final thing he could not deliver. He thought the repairs proved his commitment, and they did. But commitment is not a deed. He thought living there year after year was the same as slowly becoming the owner. It felt that way. It was not guaranteed to end that way. He had lived there long enough to know every sound the house made in the dark. Legally, that still did not make it his. If this helped you see the risk before signing one of these agreements, subscribe to Money Traps Explained. The most expensive part of a rent-to-own home may not be the higher monthly payment. It may be the years you spend building an entire life inside a house the paperwork can still take away. Before you sign anything that promises you a home, make the paper prove it. Because a key to the front door and a name on the deed are not the same thing, and the difference between them can cost you everything you thought you were buying.